Welcome to this economic policy webinar. My name is Kevin Mumford, and I'm the Kozuch Director of PURCE, the Purdue University Research Center of Economics. I've been an econ professor here at Purdue since 2007, and this was my first job after completing my PhD at Stanford. My own work focuses on evaluating the effects of public policy, using data to evaluate how government action impacts our lives. I published papers about tax policy, about the salience of federal subsidies and how government policy affects household behavior. And I've also published on the minimum wage and education topics. PURCE, our center's mission, is producing and sharing empirical economic policy research. And our researchers analyze data to better understand how laws, regulations, policies, and government programs affect our lives. We communicate our research findings to government and community leaders, as well as to the general public. This webinar that we're holding today is part of a series we've been doing for quite a while. It's part of these communication efforts. The Research Center in Economics was founded on a belief that incentives matter and that government interventions often have unintended consequences. We're a big group of scholars, and we all believe in the power of data analysis. Like, we all believe that data is going to lead us towards correct conclusions. But we're not a think tank, and we don't all think with one mind or speak with one voice. We don't have a particular policy agenda. Each of us follows the data towards whatever conclusions are supported by the evidence. So with that introduction to the center, I'll just say that during today's talk, it's scheduled to end at 11:45. I'll speak for the first bit, and then we'll have time at the end for question and answers. Nicole Brooks, who is the media relations specialist for the center, she'll be doing the QA, and so as you type in the chat questions, I won't be able to see them, but she can ask me, and then I'll do my best to respond. So to begin on today's talk, the focus is the economic impact of the COVID-19 pandemic and also the government response to that impact. And I'm going to start talking about some things controversial, but I want to point out that what I'm showing is just the data, and then I'm giving some interpretation to it. So, for example, the first chart here plots the number of U.S. deaths by month. Now, what happens is anytime somebody dies, the county records the death on a death certificate, and that's aggregated up by the states and then aggregated up to a national series. I'm ignoring all of what the cause of death is on that death certificate. This is just a count of the number of deaths from all causes. So anybody who dies in the United States, this gets listed. You know, on average, there's about 250,000 deaths in a month in the United States, and you can see some pretty significant seasonality. So January, February, and March tend to be high death months. More people are dying in the winter than they are in the summer, and you know, for a whole host of reasons. And you can sure see that. You can also see that there's a trend, an upward trend over time, and that's due to increasing population, you know, more people, but also an aging population. And if you were to estimate or predict the number of deaths we would have expected to have happened in each of the months since March of 2020, you would find that the number of deaths that has actually occurred is much greater than what we would have predicted had the pandemic not occurred. In fact, it's about 320,000 more deaths, and my data only goes through the end of November. The December death certificate data is not available yet. So 320,000 more deaths during a fairly short period of time than would have been predicted. So whatever the cause, there's certainly something going on, right? There's a lot more deaths. Now, I understand that trying to attribute which deaths are caused by the coronavirus and which ones are not is a tricky thing. And the CDC has tried to do that, and they estimate that about 2/3 of these excess deaths are probably directly related to the coronavirus. But that's messy, and you don't necessarily have to believe that estimate. The point is that there's a huge impact going on from this pandemic, where there's just a lot more people dying. Over this short period of just a few months, 320,000 people is a 15% increase in deaths. So that's important. And it had a big effect on the economy. So the sudden shutdown, just had a really sizable and significant drop, and you can pick it up in GDP. When you compare this to the financial crisis, the 2008, 2009, 2010 recession, you can see that recession is a little more gradual, and it's also not nearly as sharp. The effect on GDP was just really, really significant. And it's very obvious when it comes to U.S. unemployment rate. So this was by far the sharpest uptick since the Great Depression, and at levels we haven't seen since then. But you also see a very rapid recovery, where the unemployment rate, this was a temporary shutdown, and so unemployment falls, but still, this doesn't look good at all. I mean, this is large, and it represents a lot of people still out of work. Another point is that this increase in unemployment was not distributed in a similar way to previous recessions. So certain services and sectors of the economy were hit much harder than others, and it doesn't follow the same patterns that we saw in previous recessions. Now, job losses in most recessions do tend to be concentrated in lower wage occupations, but they tend to occur to primarily or disproportionately male workers. And this recession was disproportionately female workers to a larger extent. And some of that's because of the types of sectors that were hit most severely, including personal care and services, sports and arts, the media, and transportation, travel. Other sectors were really heavily hit, and they tend to be a little bit more female dominated. Still, construction was an extraction. Those industries were also hit hard: cleaning, maintenance, and grounds. The sectors that were not hit hard tend to be professional occupations. So healthcare professionals did not lose their jobs. Community and social services, those were kind of vital areas, right? Continuing those social services during this recession, that was vital, and so that didn't have the big downturn. Teachers, for the most part, at least in K through 12, didn't face layoffs, and so these are the areas where, for the most part, people didn't feel that same economic impact from the recession. So there's a lot of disparities here, where some sectors are hit very hard and others not so much. Some of these changes are not going to go away when the pandemic is over. So like with any recession, you have some sectors that are hit hard, and management in those sectors in the business may decide, you know what, we can make do now that we've had this experience, we can make do without some of those people. We found ways to cope, we found ways to shift work, we found ways to automate. Some of these jobs are just never going to come back. And so that's another thing that we really need to be thinking about for the long-term health of the economy. You can also see the economic impact in terms of the quits, hires, and openings. So when you see a real market drop in quits, and that's what you see happening in March of 2020, is that suddenly people stopped quitting their jobs. And that's when you have all of this additional uncertainty about what's going to go on, that becomes not a good time to a new one, and you see that in the number of openings being posted and the number of hires. They both fall dramatically. Now, it's somewhat encouraging to note that the number of hires ticked up right after that shutdown and then seems to have stabilized again. The number of openings also increased substantially, and yet the number of quits has not gone back up to the pre-recession levels, and I think that's because we're still feeling a lot of uncertainty. And regardless of the sector you're in, the virus just increases uncertainty and makes people feel less confident and not willing to leave their current job to go to something that seems uncertain to them. Okay, So now what I wanted to talk about the most, which is the government response to some of this economic impact. So in March, primarily, and then in April, the CARES Act was the initial government response. It was a $2.5 trillion response with $500 billion in loans to large businesses, which were a lot of airlines and other travel-related businesses, $350 billion in small business loans. And then there was the direct payment. So that's $1,200 per adult and $500 per child. These were checks that were sent out. People had to be below a certain income threshold. For example, for a married couple, it was an $150,000 threshold to receive the full amount. And then above that, the amount was reduced proportionally with income until at $200,000, that married couple would receive no direct payment. $250 billion in unemployment insurance expansion. What happened was, for a temporary period of time, unemployment insurance benefits were kicked up by $600 per week. That's on top of whatever the state had decided that you were eligible for. So if you qualified for unemployment insurance in your state, and if the state then started sending the checks, the federal government would put an extra $600 per week in that check. $150 billion to state and local governments, which the reason this is so important is that during a recession, tax revenues to state and local governments, they dropped significantly. At the same time, where demand for state and local government services increases dramatically. And so states don't have the ability to borrow, not in the same way the federal government does. A state can borrow to finance infrastructure, to finance a construction project, some sort of capital project, but states are not allowed to borrow to pay workers, to pay their employees. And the federal government can. So the federal government being able to borrow and then provide that to state and local government, that's pretty important. $200 billion in aid to hospitals, and then this $400 billion Paycheck Protection Program, which was businesses that were incentivized to keep their employees on the books, continue to pay them. Just in December, there was another $900 billion act that provided a boost to the Paycheck Protection Program of $300 billion, and then additional direct payments. These were $600 checks that went out. $120 billion in unemployment insurance. The amount was reduced to $300 a week, down from $600 a week. The reason behind that was that at $600 a week, quite a few people who were receiving unemployment benefits were actually receiving more than they were making when they were working. And the idea was, well, we want to continue to help those that are most in need, that are most affected, but we'll do it at a slightly lower amount. Those are set to expire in March. I think we're not very hopeful the pandemic will be over by March. It's going to take a lot longer than that to roll out all the vaccines and to get through this, and so that's a concern. And then you can see there's a variety of other things that were put into that bill. That was passed and that happened. So now what's being debated with the new Biden administration, what's being debated in Congress is the Biden proposal for a new $1.9 trillion CARES Act proposal, similar to the one done in March and April. In this case, the focus is a little bit different. $500 billion of it is directed to these direct payments with slightly expanded eligibility and larger checks sent out to families, larger checks per adult, larger checks per child. There's been some criticism that Biden had promised $2,000 checks, and the way he's justifying that is he's saying, well, it was the $600 in December plus $1,400 now. They also include $350 billion in state and local funding. The criticism about that is that it seems to be directed more towards states that already had substantial spending imbalances. And so states that were not being quite as fiscally responsible would then receive larger amounts. And so that seems to be some of the controversy there, is that it seems a little bit like a bailout, not just because of the coronavirus, but because of previous mismanagement. $250 billion in unemployment insurance, expanding that out. And I guess I've heard different proposals on this, but I think that whether we settle that is not 600 a week, but 400 a week. But the main thing is expanding it out past March. And then 170 billion for K-12 schools, universities, colleges, 160 billion for a national vaccine program with additional testing and trying to roll out the vaccine more rapidly. And then a proposal to expand the child tax credit to $3,000 a year, down from $2,000. And that's something that I've written about, is expansions to the child tax credit. Okay, and there was a host of other things in there as well. Finally, two things the federal government doesn't actually fund directly. One of them, increasing the minimum wage to $15 an hour. The federal government doesn't pay for that, but employers would all be subject to that if that were to be passed. And then extending this expanded paid leave. It expired at the end of the year. The idea was that employees are able to take up to 14 weeks of paid leave, and for a whole variety of reasons. And the justification is that if you have somebody who's sick or that has a family member who's sick with COVID, you don't want them coming into work, and this gives them paid leave time to deal with that sickness or to care for somebody who's in need. It expired at the end of the year and hasn't been renewed. It wasn't part of the December bill, and so the proposal is to renew that. Okay, so that's what is in the stimulus plan. I just want to make a few points about the effects of this response. And the first point is that the direct stimulus payments are probably the least effective part of the package in terms of what they do. So very similar to the 2001 and the 2008 payments, which were done both, that was the Bush administration. So the 2001 was a very small recession. 2008 was the beginning of the big financial crisis. In both of those previous recessions, the federal government sent out checks to households, and it was done in a very similar way. In 2001, the stimulus payments were $600 each for a married couple. In 2008, they were $1,200 each for a married couple, and they included a bonus of $300 per child as well. So we've done this before. We've sent out those checks, and economists have studied what happens when we direct payment these checks out to individuals. And what happens is that most people save the money. Most people don't spend it. Now, the issue with that is that if the money is saved and not spent, or if the money is used to pay down debt and not spent, then it doesn't have those multiplying effects of helping the businesses that are in the community. It doesn't help keep afloat local businesses and keep employment higher in other sectors. If instead the money is just being saved, it makes that person feel better off. They're feeling more secure, they've got a little money in the bank, but it doesn't have the effects that go through the rest of the economy. And so in that sense, the marginal propensity to consume is that's what determines whether or not those direct payments are going to have these multiplying effects throughout the economy. The finding from 2001 and 2008 is that about a third of the direct stimulus payments were the marginal propensity to consume. About a third of it was spent, and 2/3 of it was saved, and that's 3/4 after the checks were mailed out. So they weren't particularly effective. And economists have all kind of come to this conclusion that this is not the most effective way to get aid out either to those that are most in need or to do a lot to stimulate the economy. But the issue is that they're just not very well targeted. So yes, they're targeted to households making less than $200,000, but honestly, that's like 96% of households in the United States. That's not a particularly well-focused targeting. That's just sending it out to essentially everyone, excluding just those at the very top of the income distribution, which I think is fine. Excluding those at the top is fine, but not targeting it at those who are most affected by the coronavirus, that hurts us in two fronts. One is it doesn't get more aid to those who need it most, and two is it gives a lot of this to people who would never really spend it. Those who are unemployed have a much higher marginal propensity to consume. They really need the money, they're most likely to spend it, and then that goes out to all the other businesses and helps to keep employment higher in other areas. Now, unemployment insurance expansion is very effective at being targeted. That is, those people definitely need some extra assistance and they are going to spend the money, and that kind of stimulus, expanding unemployment insurance benefits, is great. Now, there is a trade-off if they get too high. If you expand it too much, you might be discouraging work. But honestly, I don't think that during the pandemic, certainly not right at the beginning, is discouraging work that much of an issue, because it's not like those jobs were coming back. If you were working at a restaurant or in a travel sector or something, transportation, the drop was not something to do with needing stimulus. The drop there was safety. It was COVID related. And so that means that, you know, expanding unemployment insurance benefits and discouraging those people from going back to work, they didn't have any job options anyway. So I'm not so worried about that. Unemployment insurance is very well targeted. It is a little leaky though. It doesn't reach everyone in need. Each individual state gets to determine who qualifies for unemployment insurance. And there are a lot of people, certainly not the majority, but there's a lot of people that unemployment insurance is just not able to reach. And so in that sense, we turn to these direct stimulus payments to just kind of get to everybody. But it's very inefficient when you're sending out checks to many who were not directly impacted by the pandemic. These paycheck protection programs, I think, are important because they provide a lot of liquidity, but we're still learning about all of the different ways businesses have abused this program, and I think that's a problem. So in terms of the effects of the response, the stimulus is really vital during a downturn because end up causing additional ripple loss of employment effects throughout the economy. And right now is the right time to be doing a stimulus because during the entire pandemic, interest rates have been very, very low. I mean, a 10-year treasury right now is 1.1%. That's the rate at which the federal government can borrow. When I was an undergraduate student, we always talked about the risk-free rate being 5%. And I mean, the risk-free rate, 5%, I mean, it hasn't been that now for a decade, but at 1.1%, this is just incredibly cheap. So the cost of borrowing to the federal government is very low. At the same time, the benefits of stimulus spending are very high because with all of this uncertainty in the economy and with so many people out of work, providing payments, unemployment insurance expansion, and other kinds of spending programs right now is very beneficial to the economy. So it's a good time to be doing stimulus. It's a good thing to be doing stimulus the entire time from the start of the pandemic all the way until it's over. You want to continue doing that because that's the most beneficial time. The priority really needs to be stopping the virus. It's impossible to have a strong economy until the pandemic is over. And so any efforts to speed up the efforts to stop the spread of the virus through testing or vaccination programs, that's the most efficient thing we could be doing. I think secondary, the most important thing you could be doing is expanding unemployment insurance benefits. It's very well targeted. It reaches people who need the benefits and they're going to spend it. Third, I think another really important thing you can be doing is providing direct help to state and local governments, schools, other essential industries that we want to prop up and not have failed during this period of time. So these kinds of spending mechanisms, I think this is the best thing for the federal government to be doing. The concern, I guess, is that, you know, federal debt as a percentage of GDP is very high, and you can see the effect. $4 trillion in federal government borrowing has occurred since March. And, you know, long run, having all of this debt produces lower growth and higher taxes on the next generation. And so it's a concern, but I think during the pandemic itself, it's the type of thing that you say, well, the costs are low and the benefits are high, and this is the right time to do it. But I do worry about long-term structural changes that will make higher levels of spending and then increasing deficits permanent. Because when you get to the other side of the pandemic and things return to normal, we don't want to be in this rapidly increasing federal debt state of the world. This is just a I mean, Treasury rates that are down below 1% for most of the pandemic just is incredibly low and a great time to borrow. Okay, I've had people ask me, well, why are interest rates so low? Why does a pandemic make interest rates low? And actually what's going on is, yes, the Federal Reserve, sets the interest rate, but they don't just set it to whatever they want. I mean, the reason that interest rates are really low is because there's been a big increase in the demand for safe assets. There's an increased demand so international savings are much higher, and that's because of the increase in the number of middle-class consumers in China. And as middle-class households grow and grow, there's this increase in savings from other countries. That savings ends up in just kind of flooding these markets. And when there's lots and lots of savings and less demand for investment, you end up with low interest rates. And during the increased uncertainty, businesses are saving a lot more, and even households are saving more. The marginal propensity to consume drops with the uncertainty, and you end up with even lower interest rates. So it's not that the Fed is just doing this. There's economic forces behind all of it. Okay, so I really think, just to conclude, that this summer is going to be better. The increased immunity from infections and vaccinations combined with the warm weather are going to make this summer a lot better than last summer. Some things are going to go back to normal, at least I hope. I hope that we're going to be traveling again, and we'll be able to to eat at restaurants and to do some of these services that have been severely restricted during the pandemic. But I think other things are not going to change. There's going to be some of the things that have happened during the pandemic may become at least partially permanent. That is, we're probably all going to be spending more time on Zoom going forward, because we were all forced to learn how to do these video conferencing calls and to adapt them into our daily lives. And now that's probably going to stay. Some of the drops in unemployment, or some of the increases in unemployment in sectors like manufacturing, are also probably here to stay, that some sectors are not going to recover. We're probably going to all be doing a lot more learning from home and working from home, not for everybody, but now that universities and even K through 12 schools have learned how to do distance learning much better than we knew before, I think that a lot of that is going to stick. Employment moves slowly, and we will likely not fully recover even when the virus is done, even after we've beaten it. And this summer, as things begin to return back to normal, we will still be in a weakened state of the economy. But the hope is that with stimulus payments and with the return to being able to go to the restaurants again and spend, the hope is towards pre-recession levels. All right, well, I appreciate this time to have spoken to you. Why don't we open it up and see if there are any questions?
Thank you for that, Kevin.
Sure.
I'm going to hold you to the idea that summer is going to be better. So
yeah, I sure hope it will be.
We do have a couple questions that came in. For research purposes, how will 2020 and the pandemic affect our ability to draw statistical inference from data gathered on and after 2020, maybe 5 years out, especially considering the massive shifts in the labor market for low-paying and female jobs?
Yeah, okay, so if I'm understanding the question right, it's saying 2020 is going to be this anomaly. And when you're trying to look at any sort of data analysis, you're going to have to say, yeah, but did you control for the 2020? And now it's probably going to be half of 2021 effects. And we're used to doing that type of thing. So there have been other large recessions, and every time we see somebody plotting time series or doing an analysis that includes 2008, 2009, 2010, you always want to know, did you add fixed effects, or did you control for the effects of the Great Recession? You can do that interacting those effects with things like occupation or industry, gender, other characteristics, and you can say, I'm trying to pull those effects out and focus on longer run kind of conditions while ignoring the effects that happened just during the recession. But I also want to point out that one thing that recessions do is they provide a lot of additional variation in the data that you wouldn't have seen otherwise. And so not only not only in some instances will we want to try to ignore the recession and strip it away from the data, there are other instances where we will actively use the variation induced by this recession, and we'll be using that to identify effects. So for a researcher, there's good and bad things about having a massive recession in terms of what happens with data quality. It's a good question.
Great, another one that came in. Do you think the pivot to remote work and the ease with which it happened, for the most part, will change recruitment and talent acquisition? For example, a lack of tech workers in India, I think it means Indiana, may no longer be an issue if we can tap into Texas or California on a remote basis.
Yeah, I totally agree with that. And, you know, I know a little bit about the job market in economics for professors because I'm involved on the hiring side of that and have been involved on the selling side of that. And for us, it's made a difference. You know, we did a large number of interviews remotely using Zoom for our first round set of interviews, as we've been hiring for 3 different lines here in the economics department at Purdue. And then normally after those interviews, which would normally have been done in person, after all those first round interviews, we this and do a whole day worth of presentations and meetings with individuals on campus, and those have all been done online as well. I don't know that once this pandemic is over, I don't know that we will fully adopt all of these, but we will certainly adopt some of the virtual hiring, I think. I don't know that we'll go back to doing all of our interviewing in person. We may decide to adopt virtual interviewing because I didn't see a big drop in quality of the screening. I thought that we got about as much out of the half-hour video chat as we ever did out of the half-hour in-person meeting that we were doing initially. When it comes to working remotely, that's probably also here to stay in a lot of areas. So businesses have learned that some things can be done very effectively remotely, and this forced them to learn that, and now that they know it, I think that they're much more willing to let that go long term. We've also, though, realized some things that are just done much better in person, and those certainly will return to normal once we can. So some of these changes are here to stay. I was recently talking with an expert in broadband adoption in rural areas, and I guess one thing that a lot of rural areas are thinking about is really beefing up the ability to have high-speed internet so that they can be an attractive place for remote workers to live. The job might be in a center of a large city, but the person that works in that job may prefer to live somewhere much more rural and away from all of that large city life. Having high-speed internet is kind of the key thing that will allow that to happen. So a lot of communities are thinking about that and trying to adopt high-speed internet where they don't currently have it.
The next question gets to the interest rates. Are low interest rates a tax on retirees who depend on interest for some of their living expenses and must now find other cash sources and take more risk?
Yes, absolutely. For savers, low interest rates are not good. If you're a big saver, particularly if you're a retiree that has a lot of money put away, low interest rates just means you're getting a lower rate of return. That's bad for savers. For people that have a lot of wealth, it certainly is bad. But I want to emphasize again that it's not like it's the Federal Reserve's fault that interest rates are so low. So yes, they do set a particular interest rate, the rate at which banks can borrow from the Fed and from each other. That's the rate that they're targeting. But the reason they're doing that is not just because they think it's a good idea. I mean, interest rates, they come from these underlying economic factors. And the underlying economic factor here is that there's a lot of people who are wanting to save money. And there's more savers right now than there is demand for that savings in terms of businesses wanting, corporations wanting to borrow the money in order. In an uncertain environment, people want to save more, and even businesses want to just have more in savings, and they're using less for what feel like risky investments right now when they don't really know what the environment is going to look like. And so that this low interest rate state of the world is going to recover a little bit when the uncertainty of the recession has passed. But the idea that there's been a large increase in savings worldwide, you know, a rising China means there's a lot more saving going on, and there's not necessarily enough investment to keep interest rates high. And so I think that we're going to be in a permanently, or at least long-term, lower interest rate environment. Not below 1% when the recession is over, but certainly not 5% like it was you know, back a few decades ago.
We have a question here. Are there less visible economic costs related to working from home or learning from home?
Yeah, I personally don't think that learning from home is as effective as learning in person. You know, as a teacher, I think students on average do better when they get to have class in person, but there's a lot of heterogeneity there. There are some students where learning from home is way more efficient than learning in person. And there are other students where it's just a terrible idea to be learning at home, that this has been kind of a disaster. This pandemic has been very, very hard on them. So because there's a lot of heterogeneity, hopefully after the pandemic, this will allow for some efficiency gains because we'll be able to sort better. There'll be more offerings of online education available for those that this is a really good option for. I think the same thing is true with work. We've learned now that we've all been forced to go online, we've learned where the very productive jobs are that can be done online, and where the jobs are that they don't work very well online and need to be in person. And as we've learned that, I think it's going to allow us for more efficiency gains in terms of that sorting. So I'm mostly hopeful about this going forward. I'm mostly hopeful that we've learned a lot from the pandemic and we'll be able to adopt those practices that were most successful. And then for those things that weren't successful, we can move them offline and go back to in person. And I'm looking forward to that.
In that same vein, another question, if we go to working from home and Zoom recruiting, what would you expect the impact to be on the travel, moving, and real estate industry?
Yeah, so you're exactly right that all of those kind of things, you know, may be hurt. So if we do a lot more Zoom meetings, that means we're going to be doing fewer business trips, for example. So all of the various forms of transportation will take a hit because you know, these business travelers that made up a big chunk of the airline be taking these business trips, because we've learned that some things can be done pretty effectively just over a virtual call like this. At the same time, I think that we've also learned that some things just don't work as well over a virtual call. And so I don't expect everything to become virtual going forward. There will still be this need, but airlines and other travel providers will need to adjust. And the same kinds of adjustments that means they'll happen in other areas. There is this big pent-up demand for travel. And I am anticipating that once it's safe, and I don't know how long that'll be, but once it's safe, I do think that this pent-up demand for some of these services will really show in a sudden rush for people wanting to take trips or wanting to travel. So maybe some of that will be offset for a while. I guess we'll see. But if I'm in one of those industries, I'll certainly need to adjust.
I admit I have a list of trips that I'd like to take when the time comes. We have a succinct question that I appreciate. If the stimulus payments aren't effective, why does the federal government issue them?
Okay, I don't know why the federal government does a lot of the things that it does. And it's not that they're not effective, they're just the least effective thing on the list. And the thing that bothers me, I guess, is that they're the most, I mean, when you're spending $500 billion on the direct stimulus payments, that's the biggest thing you're spending, that's the largest piece of money in the whole bill. I would like that thing to be more effective. And the evidence shows that it really isn't. In fact, the evidence on the 2020 direct stimulus payment showed that instead of like in 2001 and 2008, about a third of the money was spent in the first 3 quarters. In 2020, only about 20% of the money was spent. And they were very similar. Now, the 2021 was slightly larger dollar amounts, but they were very similar in terms of who received the money. And so why was even less of it spent? And I think the reason why even less of it was spent in 2020 is because there were some like physical constraints to being able to spend money. I mean, you couldn't go to a restaurant and spend money during a lockdown. And so some of these things prevented the spending. Because you were prevented from spending, you ended up having less of it. So the 2020 direct stimulus payments were even less effective than the ones we had tried previously, which were also ineffective. So why are we doing it? I just think that it's very, politically popular to be able to mail people checks because it makes everybody happy that you did something. But it's they're not a very effective way to do things. Now, I will say because unemployment insurance is so leaky and reaches fewer people than you would want to reach, the one thing that these direct payments could do is when you provide them to everybody, you're sure that all the people in need got one, but so didn't really need it. You could send out the checks and then ask the other people who didn't really need it to give the money back after a year. So when they fill out their next set of taxes, if they didn't actually have a drop in their income compared to the year prior, and so it looks like economically they were unaffected by the pandemic, you could have a clawback and say, for those people, this was just an interest-free loan from the federal government, and now in their next taxes, they need to pay the money back. That kind of a thing would have the added advantage of reaching those who had lost work, who had a decline in their income, that are most in need, and that'll have the highest propensity to consume. It also would provide a short-term loan to those who maybe would feel a lot better having a little extra money in the bank because of the uncertainty of a recession. But then it wouldn't have the huge debt implications of having just provided these big lump sum payments out to everybody that eventually have to be repaid through higher taxes. It could avoid some of that negative and make the program much more efficient. So I'm a big proponent of some sort of a clawback, although I realize that that would be super difficult politically because it's really hard to hand people money and then later want it back. I get why politically that's not attractive and why politically it's maybe much more attractive to just say, give out the money to everybody.
I admit I don't know all the details because I just read a headline, but there's a grassroots effort underway by someone called Redirect the Check. Mm-hmm. So some people are taking it upon themselves to get that money to where it maybe will do the most good.
Yeah, there's a lot of people who, are in an industry where they really weren't impacted. I mean, all of us were impacted by the pandemic. Everybody's had to make adjustments of some sort, but many people were not impacted in terms of losing their job or having a big loss of income. And I mean, I really appreciate these efforts where they're saying, maybe I should take that money the federal government's sending me and redirect it towards people who really need it.
Shifting gears a little, this guest notes a recent focus on buy American, so buying American products, due to the supply chain strains of PPE. How will this impact the healthcare market that is already challenged and now the costs could significantly increase?
I'm probably not the right expert to talk about supply chain stuff. We have other people here who know a lot more about supply chains than I do. I guess I could just comment briefly that it takes supply chains a little bit of time to adjust. And so when you see shortages, it's not necessarily the case that we don't have the capacity to produce that. Right initially at the beginning of the recession, there were these big shortages of things of common household products. Like the iconic one was always toilet paper. There wasn't enough toilet paper. But I mean, there's actually plenty of toilet paper production. We were no longer using giant rolls that are placed in business establishments, and instead we were using household rolls. And it's hard to go to the store and then buy one of those giant industrial size because they don't fit in your little holder in your bathroom. And so it just took time for producers to adjust to the change in demand and then for the supply chain to adjust. I think the same thing is going to be true in any market, which is it just takes time to adjust. And I'm confident that it will, though. I mean, there's all the incentives are in place for these things to adjust without the government needing to get involved in it. The market has a way of taking care of this, although it'll take some time.
So another question, with federal support to wipe clean the debts of some states, could an argument be made that these states are now free to grow at a higher rate than before and debt to GDP may correct itself, albeit slowly, without significant tax policy changes?
Okay, good question. We probably should be maybe concluding on that because we're coming to the end of our time. I understand the argument here, which is that we've had some states that have made poor fiscal choices, have ended up in a lot of debt, and if we wiped their debt clean, that would open them up for the ability to grow perhaps more rapidly in the future. So there's arguments for and against this type of thing. I'll just say the argument against it seems to be that it creates some moral hazard issues. That is, if when you bail out a company or if you bail out a state government or a local government because of poor choices, if that becomes a pattern that the federal government establishes, it'll lead others to say, well, if we got bailed out last time, we'll get bailed out again. Let's keep making these same kinds of choices. And so I think that that's the tension going on right now. But I mean, the answer to the question is absolutely. If you paid off the debts of a lot of states, I think that it would increase growth. Would it increase it enough to pay off the cost of that future, the cost of all that borrowing and so on? Probably not. But I mean, at least it has the effect is in the sign that you suggested.
I just want to say we have lots of other great questions. We do have to wrap up because of time, but if you have a burning question, you can send it to purce@purdue.edu, and I'll put that in the chat, and I will make sure that Professor Mumford gets it. Yeah, too many good questions to read in the time allotted, which is a great problem. So thank you so much.
Well, I'm so appreciative of having so many of you come to this PURCE Economic Policy webinar. I hope you enjoyed it. These kind of things are really enjoyable for me. Like, I've really enjoyed attending and listening to all of the various experts we've had speaking over the past few years. And just because I care a lot about government policy and I enjoy opportunities to interact with scholars who have been studying the effects of particular government intervention. They affect all of our lives. And so I think it just, for that reason, it's very interesting to me. I invite you to help PURCE with our mission to share empirical policy relevant research findings. You can find out more about our research at our website, which is listed here at centers/PURCE. I invite you to consider donating to support our current initiatives, and we try our best to provide special experiences for undergraduate students, and also to do a lot of outreach, not only to the public, but also to government leaders. Just this week, we had a great session where Professor Jillian Carr was able to speak to a number of state senators, state representatives, members of the State Board of Education about the adoption of the SAT test as a new standardized test for all juniors in Indiana to take simultaneously next year. And so being able to have that direct, provide direct feedback to lawmakers is also something that PURCE really values. Thanks for attending this broadcast. I'm glad to have seen you here, and this now concludes.